Hey friends, Loss Ratio here, and welcome to the very first episode of Loss Ratio Talks About Insurance while he tries to ride a snowmobile. In this episode, we are going to scratch the surface of the topic of underinsurance.
This could be interesting.
Specifically in the property insurance market, and even more specifically, homeowners insurance. Now, the issue of underinsurance in the homeowners market is no secret. There has been plenty of information documented and published over the years, and the issue of underinsurance typically gets the most attention in the wake of major cat events like the most recent California wildfires that all too often reveal massive amounts of underinsurance on a massive amount of property. So for clarity, let's first define what we're actually talking about here. When we say property underinsurance, what does that mean?
What are you talking about?
What I'm talking about here when I say underinsurance is the coverage A amount, the dwelling limit on a homeowner's policy not being aligned with the actual replacement cost value of the structure being insured. So for instance, a homeowner has an insurance policy with a $500,000 Cov A limit when the actual cost to rebuild their home in its current state is $750,000. In such a scenario, the homeowner is underinsured by $250,000. And this is a huge problem that is all too common.
It happens all the time.
It causes a multitude of issues across the insurance ecosystem and ultimately is a bad thing for everyone. Now, this is a topic that we could discuss for hours, but for the purposes of this video and in keeping things brief and manageable, I'm going to talk about one specific scenario of how underinsurance happens. Because like most complex insurance problems, this is a multifaceted problem.
It's complicated.
There is not one singular cause, and therefore there's not one singular solution. There will be multiple subsequent episodes on this topic talking about other angles, but in this first episode, I want to talk very specifically about the agent or broker's role
Secret Asian man.
in this problem of underinsurance. So to kick things off, we first need to understand how that coverage A limit is typically set on a homeowner's insurance policy. How does anyone ever actually know if their home is appropriately insured? Well, here's how this works. Anytime that a new homeowner's insurance policy is written and issued, what is commonly referred to as a replacement cost evaluation will be completed on that home. So how is that replacement cost valuation created? While there are some small variations across the industry from carrier to carrier, the vast majority of the time, the agent or broker will be completing a replacement cost valuation to submit with their policy application. There are really only 3 players in this replacement cost evaluation space, 3 different companies that have each created their own proprietary replacement cost valuation tool. All 3 of these are pretty major players across the insurance ecosystem, and these replacement cost valuation tools are one small piece of the greater ecosystem of solutions that they provide to the insurance industry. So what does this look like for an agent? Well, when an agent is submitting an application, they need to provide a replacement cost valuation along with that application to validate to the carrier that the coverage A amount that they're requesting for the new policy is accurate and appropriate. So what's involved in this replacement cost valuation?
That's a good question.
In order to complete a replacement cost valuation, an agent will need to input a number of data points into the valuation tool, which will in turn generate the actual replacement cost figure for that home. These data points include things like the square footage of the home, the roofing material, the siding material, the foundation type, etc. So again, anytime that a new homeowner's insurance policy is written, there will be a replacement cost valuation associated with that new policy. So understand that this replacement cost valuation tool, process, and carrier protocol is designed to prevent underinsurance from happening. Its primary purpose is to ensure proper insurance to value. In other words, the coverage A amount on the homeowner's policy is going to provide an adequate amount of money to the homeowner to rebuild their home if, heaven forbid, it was ever completely destroyed in a covered claim event. So, if the insurance industry has this process and protocol in place, how in the world does underinsurance happen, and why is it such a pervasive issue?
Good question.
Let's dive into some details of how this happened. And I'm speaking here from direct personal experience on two different sides of the equation. I spent quite a few years as an agent myself, writing many hundreds of homeowners insurance policies, and I've now spent over a decade on the inspection vendor side, creating and reviewing literally tens of thousands of replacement cost valuations.
Oh, we're going through a tunnel!
So here is one very common scenario that I have seen and experienced many, many times. And remember, this is just one aspect of this problem. But here's the all too common scenario. Let's say a homeowner in California is shopping for a new homeowner's insurance policy. They've been insured with the same company for 10 years and their policy premiums have continued to increase year over year, and they've decided to shop their policy around to see if they can find a better deal with a new insurer. So they head to their local independent insurance agent's office, walk in the front door, and they slap their existing homeowner's insurance policy down on the desk in front of the agent. And more often than not, the homeowner will make the following statement: I want an apples to apples quote.
I like apples.
If I had $1 for every time I've heard that statement as an agent, I would be a very rich man. And it makes sense. I understand why homeowners say that and think that, because from their perspective, the only way that they can truly know if they're getting a better deal is to get an apples to apples quote that matches their current coverage. If they get a quote for different amounts of coverage, it's really difficult for them to determine if they're actually getting a better deal or not. So consumers are always asking for this apples to apples quote. Let's say in this scenario, the agent looks at the existing policy and he sees that the Cov A amount on the existing policy is again $500,000. If the agent decides to grant the homeowner's request for a true apples to apples quote, they will create a quote that matches the $500,000 coverage amount of the existing policy. However, remember, we said in this case that this existing policy is 10 years old.
I know spring chicken.
The homeowner's been with their current carrier for 10 years, and this policy has never been updated. So what does that mean? Well, it means that perhaps the accurate replacement cost for that home 10 years ago was $500,000. But guess what?
What?
A lot has changed over the past decade. The cost of construction, building materials, as well as labor has changed dramatically over the last 10 years. So while that house perhaps could have been rebuilt 10 years ago for $500,000, today it could easily cost $750,000 or more to rebuild that house. So the homeowner is currently significantly underinsured, but they are obviously not aware of it because the average consumer, the average homeowner, has little to no knowledge of replacement cost values and no way of really knowing what it would actually cost to rebuild their home today. So now the agent has a decision to make.
Decision time.
If the agent is truly committed to doing what's best for this homeowner, then they need to have what can often be a difficult conversation. They need to tell this potential new client, look, I understand you're asking for an apples to apples quote, but unfortunately, that is not what you need. And if I sell you an apples to apples policy, you're going to be grossly underinsured. And guess what? The vast majority of the time, this is not what the homeowner wants to hear. The whole reason they decided to shop their policy and come talk to this agent was that they were looking to save money. That is most often their goal and intention. And if the agent is now telling them that they actually need to increase their coverage by 50% or more, there is slim to no chance that they're going to be saving money here. Rather, they're actually going to end up paying more. So we're starting to paint the picture here of how complicated this can be.
It's complicated.
If the agent or broker is actually fully committed to doing what is best for the homeowner, they absolutely need to have that tough conversation even though it's not what the homeowner wants to hear.
Or 30 on the subway.
However, what if the agent or broker is not committed to doing what's best for the homeowner, and they're more committed to writing the policy, growing their book of business, and collecting the commission? And I can say from, again, direct firsthand experience, this happens way too often.
Dude, I'm doing crazy stuff like that like all the time.
Agents and brokers are out there grinding. They have revenue and new business targets that they're trying to hit, many times trying to qualify for carrier bonuses and incentives. And so the temptation can be high to cut corners here and write policies that they know do not provide adequate coverage. And remember, very often in these scenarios, that is exactly what the policyholder is not even asking for, but sometimes even demanding. I've experienced this scenario many times myself, where I had the tough conversation with the policyholder and told them that they were currently underinsured, and they literally looked me in the face and said, "I don't care. I'm trying to save money here. Will you write me a policy that is identical to my existing coverage? Because if you won't write it, I'll find another agent who will." And one other interesting aspect here before we move on.
You might find this interesting.
One of the reasons that way too many brokers and agents are knowingly underinsuring properties is the simple fact that the odds are highly in their favor that no harm will ever come from it. The chances of any individual homeowner actually ever experiencing a total loss and needing that full replacement cost coverage amount is statistically very low. And so because of this very strong statistical improbability, many agents and brokers are willing to make that gamble. Now, my intent here is not to pile on agents and brokers, because again, this is just one angle. This is one part of the problem. And at the same time, there certainly are many scenarios where agents and brokers are unknowingly underinsuring policyholders. They may not be extremely well versed in how the replacement cost valuation tools work. They could be inputting incorrect data, therefore getting an inaccurate replacement cost valuation and underinsuring without even realizing it. I know, again, from personal experience that in my first year as an agent, I knew very little about how to accurately complete a replacement cost valuation, so this can certainly be a factor with inexperienced or newer agents as well. So let's wrap up here by talking for just a few minutes about the consequences of this problem. If the agent or broker, either by conscious choice or inadvertently, underinsures this property and writes the policy for $500,000 when the true replacement cost value is $750,000, and subsequently the home tragically burns to the ground, like many thousands have in these most recent California wildfires. The insurance carrier will likely pay out the policy limit, so now the policyholder has their $500,000 coverage A amount, cash in hand, but when they get bids back from contractors to rebuild their home, they quickly find out that they don't have nearly enough money to rebuild the home that they lost. This is obviously devastating for the homeowner, and more often than not, enter the plaintiff's bar.
Ladies and gentlemen of the jury.
These legal battles typically drag on for many years, costing carriers tens and often hundreds of thousands of dollars in legal defense expenses. The agent or broker's errors and omissions policy is typically tapped to cover their liability, and in the end, quite literally, everyone loses, except perhaps the plaintiff's bar.
Man's gotta make a living, right?
So I'm gonna wrap up with that. I hope you found this interesting. As always, I'd love to hear your thoughts in the comments below. What resonates with you? Where do you think I'm wrong? Let's continue the conversation. Stay tuned for the next episode, where I'll be taking the spotlight off the agents and brokers and putting it onto the carriers. What is the carrier's role and responsibility when it comes to these issues of underinsurance? Thanks so much for watching, and I'll catch you in the next episode.